This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company today. Coming up on the program, two interviews especially you won't want to miss. The OECD's 38 members include the most powerful economies on earth. Its Secretary-General is Mathias Cormann, Australia's former Finance Minister. Well, he was back in Australia from the OECD's Paris headquarters this week, and I spoke with him exclusively for Business Weekend on the current delicate state of the global economy.
We live in an interconnected global economy. I mean, Australia is a globally focused, export-oriented trading economy. What happens in the rest of the world matters to us here.
And the world right now is on the brink of the next phase of the Industrial Revolution, fuelled by generative artificial intelligence. But for that AI to work, we need data centres, giant data centres as big as regional towns. And the man building many of those data centres is Craig Scroggie, the founder and chief executive of Australia's leading independent data centre operator, NextDC.
This is an extraordinary moment in history. I think we're privileged to be alive at this point in time.
And look, right now, you know it, I know it, plenty of taxpayer money is being spent to make housing more affordable and to help first home buyers get a leg up into the market. So we ask the question today, is it really any tougher to buy a first home today than it was when interest rates were 17% or say when unemployment was 8%, not 4% as it is today?
The big thing that's changed if we look over the last 4 or 5 decades is it is just much harder to save a 20% deposit than it used to be.
We also dissect what's really happening at the building supplies company James Hardie, whose shares have tanked as it appears to be walking all over its Australian shareholders. So all that and plenty more coming up on today's program. But look, let's start with where Australia sits economically right now. This week's economic growth figures, 1.8% for the year to the end of the June quarter, were better than expected, and that's great news. No two ways around it. Australia needs its economy to grow faster. But drill just a little deeper into these numbers and there's still cause for concern. Much of the growth in the past quarter came from households spending more money, cutting into their savings, which again is no bad thing. People's confidence to spend comes from the prospect of lower interest rates, higher house prices and security in their jobs. But what Australia really needs is for business to gain confidence and to invest. In these accounts, private investments barely grew. Business investment went backwards. As infrastructure projects were finished, government investment has also started to wane. The problem of having an economy generate its growth by people spending is that this in of itself is not productive. It's simply recycling money. As it happens, because more than 50% of new jobs are related to either government projects and programs or the public service, it's recycling money. The government effectively is borrowing. What Australia needs urgently is to grow faster via business investment, investment that will generate jobs and income, taxes into the future. But that's not happening immediately. You've seen us interview chief executive after chief executive in the past few weeks, and they're giving preference to the US for new investment over Australia. And that's for a simple reason. They foresee making more money there than they do here. And that's because, as we keep saying, Australia has lost competitiveness in energy prices, in wages, and in taxes. And there's one more thing. The Reserve Bank is not the answer to Australia's economic ills. It can't alone create the economic growth that our nation needs. Government policy has to change, needs to change. The signals from government have to foster business and encourage entrepreneurialism. And that doesn't come from raising taxes and higher energy prices. Well, this week, the Reserve Bank Governor, Michelle Bullock, also sent a signal. She says the increase in household spending sends a sign that inflation could actually rise, and that could clip the number of interest rate cuts, eventually, delivered by the Reserve Bank.
We are seeing it come back, and that's welcome. We're seeing the private sector start to demonstrate a little bit more growth now, which I think is positive. What it means for future of interest rates, I don't know at this stage. But all I would say is that it's, if anything, probably it's a little stronger than we thought it would be. So that's good, but it does mean that it's possible that if it keeps going, then there may not be many interest rate.
What Australia desperately needs from government right now are clearer signals that show Australian business can be competitive with the world, that we can grow by selling goods and not just by simply reshuffling money to each other in our domestic economy. Well, somebody who is highly conscious about the global economic competitiveness is the Secretary-General of the Paris-based Organisation for Economic Cooperation and Development, Mathias Cormann. Cormann, Australia's former finance minister, has been leading the OECD for 5 years and recently was reappointed for a further 5 years. Well, this week he was back in Australia and I spoke with him exclusively for Business Weekend about economic cooperation between his 38 member nation states in a world where the US policy of tariffs smacks of growing isolationism.
We live in an interconnected global economy. I mean, Australia is a globally focused, export-oriented trading economy. What happens in the rest of the world matters to us here in Australia. Indeed, we have a real interest in well-functioning global markets, in a rules-based global trading system, in good working order, and overwhelmingly open markets and rules-based trade have delivered significant increases in incomes and living standards all around the world. Now, yes, I mean, it is true that there are some genuine and legitimate policy concerns about the way global trading arrangements have been operating, concerns around unfair trade practices, concerns about supply chain resilience, economic security, an unlevel playing field, and the like. But it's going to be important moving forward, including for businesses and households in the United States, that these issues are resolved in a cooperative way through dialogue. And from all of the conversations that I've been able to see in the G7 and across the OECD Council table, I can see that there is continued engagement in finding the best possible ways forward. And I mean, even in relation to the tariffs announcements, and I mean, what you would have seen is pauses of certain applications with an effort to find bilateral resolutions. And we would certainly encourage governments around the world to continue to pursue positive outcomes-focused conversation, bilaterally and multilaterally, to make international trading arrangements fairer and function better, but in a way that preserves the economic benefits of open markets and rules-based trade. And from Australia's point of view, that is certainly very much in our national interest for that to be successful.
Because one of the things you're seeing in Australia right now is a real flow of capital out of the country, not only by multinational companies making decisions increasingly to go to the United States, where they're getting cheaper energy, cheaper taxes, bigger markets, and even cheaper labour forces as well. This whole notion of isolationism comes with competitiveness issues as well, I would sense.
Well, I mean, Australia, again, as a globally focused, export-oriented trading economy, needs to be very mindful of the need for the economy to be internationally competitive and for us to be an attractive destination, including and in particular when it comes to foreign investment. But, we have many, many attributes too. I mean, we are in the part of the world that has generated the most significant growth in the global economy for some time and is expected to continue to deliver a strong contribution to global growth for many years to come. And that has generated many opportunities for Australia over the last few decades. And as long as we maintain the appropriate policy settings, we will continue to be able to seize those opportunities. But yes, I mean, as markets evolve, as the global trading and investment environment continues to evolve, we need to continue to think very carefully on the steps that we need to take here in Australia to remain internationally competitive and an attractive destination for investment.
So tell me, this week we saw very strong images of Vladimir Putin from Russia, from Xi Jinping from China, and Narendra Modi from India together at a forum. Does that again send a message to the world about not only the relative strengths of these particular blocs, but also then even the ability to lock up key minerals that might be needed for the development of Western economies, including rare earths?
Well, look, I mean, governments around the world will talk to each other, and we certainly think that market-based democracies around the world need to be very focused on shaping the global agenda and shaping the global conversation when it comes to making the right decisions about strengthening the global economic growth outlook and strengthening opportunities moving forward. I mean, fora like the G7, but also the G20 and APEC and other global economic fora are important platforms for market-based democracies to help shape the global conversation on all of the issues in front of us.
So take me to those rare earths in particular. You spoke about those this week, and I'm just wondering where you sense the supply of those rare earths. Australia has many of those, but it's, again, a raw resource rather than being actually developed into something which might be otherwise used. Is that the sense of where Australia might fit into this global economy, this new global economy into the future?
Well, there's a couple of developments that are happening globally. I mean, firstly, current supply of critical minerals and rare earth is highly concentrated. There are increasing levels of export restrictions and protectionist measures when it comes to the export of these minerals, and at a time when the demand for critical minerals and rare earths is expected to significantly increase in the context of both the green and digital transformations of economies around the world. So, in that context, indeed, there are some exciting opportunities for Australia to be part of the global supply of those minerals and those rare earths. But more broadly, it's one of those areas where it's important to ensure that we can have globally secure and reliable supply chains.
Energy is clearly one of the key competitive advantages or disadvantages that nations have. Australia seems to be at a disadvantage at the moment as it's trying to go out to roll out its renewable program. You this week gave advice to your former party colleagues inside the coalition that they really should think twice about scrapping net zero, if that is certainly a push inside the party that I've heard as well. What's your own sense on this and where it goes to, and whether Australia can genuinely be competitive on its energy supplies in the future?
Well, it was a coalition government in 2016 that signed on and ratified the Paris Agreement, which includes a commitment, among other things, includes a commitment to achieving net zero emissions by 2050. So, Australia is a signatory to an international agreement and is bound by the commitments that we made under, as I say, a coalition agreement. So it's in that context that I've said really the conversation we ought to have in Australia, the policy conversation that Australia ought to have is not whether or not to pursue that objective, but how it is best achieved and how we can achieve net zero emissions in a way that preserves our international competitiveness, that helps us preserve economic opportunity, indeed enhance economic opportunity, and indeed helps us preserve and enhance our energy security and energy affordability in a way that also helps us meet our climate objectives. Now, different countries around the world, based on their opportunities, are pursuing different strategies, and that is, of course, appropriate. And Australia will make its own judgments ultimately. But what I would encourage everyone to do is to focus on how we can achieve this objective in the best possible way, rather than continue the debate on whether or not this is the right objective to pursue.
And of course, the coalition took to the polls last year a nuclear energy policy, which was overwhelmingly rejected, the Labor Party would have it, by the community. But many other countries around the world, as they try and get more energy, more affordable energy with no emissions, to be able to really fuel their data centres and artificial intelligence into the future. I just get a sense that really, again, there are different strategies which might leave some countries more or less competitive in the future.
Well, a reliable and affordable supply of energy is indeed a key factor to economic competitiveness, moving forward. And it is also true that, quite a number of countries and quite a number of OECD countries around the world are pursuing nuclear energy and are pursuing strategies to increase nuclear energy supply as part of their strategy to achieve a reliable and affordable supply of baseload energy. And at various COP meetings in recent years, there have been commitments by a large number of countries to indeed make nuclear energy and access to nuclear a core part of the transition to net zero emissions by 2050. But in the end, I understand that this is a contested conversation in Australia. By the same token, Australia on that front has some natural advantages, and I suspect that as the energy conversation continues and as the affordability and reliability pressure and the pressure of meeting climate objectives continues to evolve, the conversation around the opportunities of nuclear energy in Australia will continue.
We've talked about most of the issues that affect competitiveness on a global basis and then brought it back to Australia. Mathias Cormann, always great to chat to you and many thanks for your time today.
Great to be with you.
Well, after the break, we get a behind-the-scenes look at one of Australia's biggest data centres with NextDC founder Craig Scroggie, who'll explain why we're only at the very beginning of the artificial intelligence boom. Thanks for being with us here on Business Weekend. Well, Craig Scroggie, the founder of data centre owner and builder NextDC, I've got to tell you, he's a force of nature, full of energy and ideas. And this week he showed me around one of his company's 17 data centres. The astonishing thing is the company's got another 17 in the planning, and one of those is 10 times the size of the giant structure that he took me around this week, what he calls a new town for Australia. It's just a town full of computer servers. But these servers, no matter the misgivings about energy and water use, are essential pieces of national infrastructure. Australia can't afford to fall behind in the race to roll out generative artificial intelligence. And to be fair, you sense the federal and most state governments genuinely understand this. But Craig Scroggie has astonishing insight into how this all will play out. It's one of the more important interviews you can listen to from an Australian perspective right now. Scroggie, always good to chat to you, but this time face to face, which is terrific. Just explain to me where we are right now in this S3 data centre in Sydney.
We are in the centre of the internet universe. All of our digital infrastructure lives in a world-class facility like this. Whether you use online video systems, Netflix, you listen to Spotify, you are using Office 365 for your enterprise email, that critical infrastructure lives in a data centre. And those data centres need to live in the communities and around us to provide all of those services that run our digital lives.
Okay, so in this data centre, are there those new GRU chips that NVIDIA has created, which create the generative artificial intelligence that now is, the big boom in the world right now?
NVIDIA is an amazing story. When you think about the course of the last decade of computing, we've been through the internet era, and that was largely defined by cloud computing. So there was pay per use. It was building compute services that organisations were able to not build and deploy and manage infrastructure in their own buildings, but to start to use pay per use computing. The next era of computing is the one that NVIDIA is defining in real time. And the GPU era is the move to direct liquid to chip cooling. The compute infrastructure is 10 to 100 times more dense. And this is the era where GPUs will start to produce intelligence or manufacture knowledge.
So do you have them here physically?
We do.
You do. And are they easy to acquire? Because obviously, really, if you think about it, ChatGPT, OpenAI, has really only been around for the best part of, not 2 years yet.
Yeah, November 23, yeah. for most people, an incredibly important moment in the history of large language models and a really significant advancement in artificial intelligence, because it's when AI became a consumer-facing product and everybody could see the power of what a large language model was capable of doing. Essentially, the production of tokens is the output from those GPU.
Which people would know through Bitcoin and crypto in particular. That's right, isn't it? Because that was a generation of tokens to create those digital currencies.
Yeah, many of the things on the blockchain, if you think about the way crypto worked, is the mining of tokens. And it's interesting because a lot of the companies that were crypto providers in the early day have now transitioned into this extraordinary opportunity, which is the production of tokens to manufacture intelligence. So many of those crypto companies have now moved into the selling of GPU as a service, which is selling on-demand capability.
So what you're saying, this is the heart of the internet, but it's also the heart of the future of our economy. That's the reality, because what comes out of here is not only just all the intelligence and the information, but the future business ideas come out of here as well. The future research comes out of here.
Yeah, data centres for a long time obviously have been the home for computers. So when you think about efficiency, what is a data centre? So let's use an example. In a transport context, we have planes, trains, buses, cars. And with data centres, most of the infrastructure used to be on-premise. A bank had a data centre, a telco had a data centre. And when you take those computers out of office buildings that weren't designed to be highly energy efficient, you can put them into a single building that can run those computers at a much higher density, at a far lower cost, and we get a significantly better sustainability outcome by essentially taking lots of cars off the road and putting people on buses.
Okay, but then the argument is that data centres require energy. So therefore, is cheaper energy prices, does that make a data centre more efficient? Does it make our data cheaper for us to use ultimately?
The energy trilemma is a great topic. There are three elements ultimately. When we think about Australia's role in the global computing landscape, Australia actually has an incredible opportunity to be a world leader in the future of artificial intelligence. But we do need to solve the energy trilemma. We need green electrons, net zero sustainability. So that's an important aspect. We need firm electrons because at night, and we're blessed with an amazing renewable landscape in Australia. But when the sun's not shining and the wind's not blowing, at night when you go home and you want to watch Netflix, use your on-demand computing services, we still need that baseload power to run digital infrastructure.
And that becomes more important the further these data centres are away from where that energy is being sourced, isn't it?
The types of data centres, so we have very big hyperscale data centres, they run cloud computing and AI systems. There's different types of AI training. There's AI training of large language models, and then there's the AI inferencing, which is the interacting with the model. We have metropolitan data centres, just like this one that's very close to the heart of the Sydney CBD, and it's hosting customers that have low latency requirements. They want cloud on-ramps. They want to be able to get access to their data within milliseconds, and so the location of it's critically important.
So there's going to be financial services, that's going to be telcos.
Hospitals.
Yes.
Emergency services, real-time telemetry systems.
So in other words, if you're running robotic operations in a hospital, you'd need to use a data centre like this very close so the latency is very small.
Well, if you go even one step further to the edge type of data centres that we build, the edge serves a couple of functions. The first one is Australia's internet traffic. So our Sunshine Coast facility will have almost a third of Australia's internet traffic flowing from the west coast of the US into the Sunshine Coast and then through Australia. Those are cable landing stations that allow that internet infrastructure to connect Australia to the rest of the world. The other application is that we have mining customers and others in remote areas. We build in Darwin, we build in the Pilbara, in Port Hedland and Newman, because not only do you need telecommunications infrastructure that supports terrestrial fibre and submarine cable, we have increasingly an extraordinary number of satellites being launched in LEO, MEO and GEO infrastructure that allow us to use services. If you fly on a Qantas plane, you'll use Viasat's service to get internet access when you're in the air. If you live in remote Australia, you probably use the SpaceX Starlink infrastructure to get high-speed internet access. Many of those are run in these edge data centres. And then you've got mining safety systems and large-scale data telemetry for big data sets that doesn't need to be brought back to the cities. It can be processed at the edge. So there's many different types of applications.
Go back to energy. You and I in the past have talked about nuclear energy. You're a proponent for nuclear energy. You think it should be necessary in Australia. And the reality is that in many big data centres, giant data centres in America, they're starting to build sort of the nuclear reactors alongside the data centres. Such is the need for that energy to be on all the time. We're not there yet. Is it an argument still to be had in this country?
Look, nuclear is obviously a really sensitive political topic in Australia. And when I'm asked the question about this, I like to think that I am pro-science, not necessarily pro-nuclear. I'm pro any energy source that will allow Australia to solve the energy trilemma: green electrons, firm electrons, and the lowest cost electrons that we could possibly get. Australia as a competitive nation has an opportunity to build an AI industry and a workforce. The history of mining in Australia that built the Australia that we know today was built on the export of resources. The future of Australia mining could be the export of tokens. through the production of artificial intelligence. But we do need to solve the energy trilemma. And in order to get firm electrons and get cheap ones, we need to consider every new energy alternative. Nothing should be off the table.
Okay, so Sam Altman, who created OpenAI, he's the boss, the founder, he's now thinking about data centres which could be as big as Manhattan Island, which are astonishing to think of the scale of that. Is that something that even Australia needs to contemplate in the future?
We just announced our $15 billion joint venture for our new Sydney development, which is 850 megawatts. So it's just under 1 gigawatt of compute.
Explain that to an ordinary person like me.
It's really big.
Yeah, right. Okay, that's good enough.
It's really big.
What about in
well,
terms of
the entire building that we're in today, which is enormous, it's huge. It's just under 100 megawatts.
Yes.
So it would be 10 of these. It's a big city.
10 of these?
Yeah. It's a big city.
So it's literally like a small country town?
Yeah, it's a town. And building them and constructing them on that scale is essentially like building a full physical community, but you're also building a digital ecosystem at the same time. If you use that example of a gigawatt data center in the US, enormous data center demand, the bulk of training for large language models today that's driving the growth in artificial intelligence and GPUs is being done in the US. And you're seeing places like Abilene in Texas where they announced the 5 gigawatt development for Stargate. Those scale infrastructure projects are the largest digital infrastructure projects that have ever been undertaken in the world today. Now, yes, they're hundreds of thousands of GPUs and they're hundreds of megawatts of power, water, all of the other resources that are required to build those digital cities. And we are building them here in Australia. We are incredibly positioned, well positioned, uniquely positioned, a Five Eyes country, a trusted security partner, a stable political landscape to work in, a known regulatory environment. Australia's a great place to be able to build some of the world's largest digital infrastructure. Sure, there's a few things to solve. The energy trilemma, copyright, protecting the rights of existing users, but also at the same time finding the logical path to creating exemptions for text and data mining legislation that acknowledges that copyright owners need to be protected, but allows training to take place.
I was going to ask you about copyright because that's one of the big issues right now. Who owns the data? If I've generated something, is this mine? Have I got a copyright over that? Or is that something that can be scraped in this modern world of artificial intelligence?
Large language models are trained on all publicly available data. So when you teach a model, and particularly general artificial intelligence, so general model, it's trained on all and any information it can get, text, audio, video, and that's how it builds its knowledge base. It's like sending a child to school and they learn. And then when we send them out into the wild and they graduate from school, they start interacting with the community, and that's inferencing in the large language model sense. Doing that in Australia on large scale, the training component, today it's not clear under the text and data mining laws that that's not infringing on copyright. So the first critical thing for us to be able to do is simply acknowledge that we want to protect the copyright owners' rights. This is not a hugely complicated problem to solve, because if you go all the way back to Steve Jobs solving this for Apple Music, Spotify having solved it, acknowledging and protecting copyright is something that we have a mechanism to solve for today. If we make that clear, the US, Japan, Singapore and the European Union have given definitive carve-outs for the training of models. Australia will make its own regulatory decisions, and should. The quicker we solve that, the bigger opportunity. We will unlock a wall of billions of dollars of global infrastructure investment in Australia if we get clear on that issue.
Okay, then another one. How important is it for Australia to have sovereign capability of its own data?
Well, I think that is a fundamental right of every country, and it's going to be increasingly important in a ever-evolving geopolitical landscape. We live in interesting times.
Because the AUKUS submarine project, for example, you would want to know that the data from that is kept securely in Australian hands.
I think in a national security sense, we'll always want to know that we control our data, that we decide who can access it, and that we can secure it and protect it from foreign adversaries. I think that's a really important principle in the protection of sovereign infrastructure. For many digital and critical infrastructure providers in Australia, we are classified as a SON under the SOCI Act. So those people who build and operate digital infrastructure are held to very high standards around the protection and the ownership and operation of assets. And I think that then extends out into the data universe itself, making sure that we have the infrastructure built in country, that we have the data resident in country where it is subject to our laws and our regulation, and that we know that we can protect it.
Craig Scroggie, always great to chat to you. Many thanks for your time.
Thanks, Ross.
Coming up, James Hardie might have been an Australian business icon for 137 years, but its local shareholders are up in arms as the company's shares tanked and the business seems to be off to America. It's good to have your company here on Business Weekend. Well, James Hardie came to Australia from Scotland back in 1888. Not long afterwards, he came across a French product called fibro cement, which he started to import from France. But together with a friend, Andrew Reid, they started making fibro cement here, at first with asbestos, which eventually caused the company real issues. Well, today, James Hardie's biggest base is in America, but its treatment of Australian shareholders is very much in question. A decision to move its stock market listing to the US, a controversial $14 billion US takeover, and a massive plunge in its shares caused by a profit fall that had not been flagged to the markets. Ingrid Willinge investigates what happened inside this Australian household name.
It was another shock to the system, the company sensationally missing expectations, putting out a result that was almost hard to believe. The guidance for 2026 also well below forecasts.
James Hardie has missed analyst expectations on the EBITDA front by almost 30%. Now, they report quarterly. It is actually quite difficult to miss consensus earnings by 30%. A quarter ago, they actually have spoken to the analysts and then the market about, the destocking sort of environment coming to an end. And now at this result, they actually say it's picked up again. So look, either the market has taken another step down significantly, or there's something funny going on with James Hardie's core business as well as the new acquisition.
Not only was there a fall in quarterly sales, but it was almost all attributed to the North American business. It comes amid a housing downturn in the US and tough economic conditions there.
Despite the Fed having cut interest rates a few times already, I mean, longer term bond yields in the US haven't declined. And, the way the system works over there, a lot of mortgage rates key off the long-term bond yield. So a lot of people, most people have fixed rate mortgages, and those mortgage rates haven't come down in the last few years. They're still at pretty high levels. And secondly, many people did lock in very low mortgage rates back during the pandemic.
It was a wipeout for the share price, losing almost 40% over 2 sessions. And so it was the company's integrity that's come into question, with local investors asking, where was the profit warning and how could the market be allowed to get it so wrong without contravening ASX regulation?
The rule in the ASX is clearly within 15% of the earnings variation that you need to warn the market. But clearly for James Hardie perspective, the variation is in analyst expectations has been quite wide. Remember, the company is now shifting big part of its investor base into the US. So there's quite a bit of US coverage where their earnings variation to the US analyst expectation is not as large as what they are here in Australia. So look, it's a huge surprise for analysts over here and then for the market. And we have seen the share price reaction over in the US investor as well has been quite severe.
And yet it was only back in March when Australian investors were blindsided for the first time. A deal with American outdoor decking and railings company Azek was inked, worth a whopping $14 billion. James Hardie billed it as playing directly to its strategy, selling more fibre cement to clad homes, and the result of the January LA Palisade fires meant many Americans were on a forced path to rebuild. But this wasn't your regular big-ticket deal. Instead of local shareholders being allowed to vote on it, they were not given a say. The ASX granting the company an exemption with an obscure listing rule allowing companies to issue large amounts of shares for takeovers without a shareholder vote.
Investors really disappointed. They're disappointed in the governance and the running of this organisation. So looking back at that deal, what happened was they didn't take it as a resolution to vote of investors and instead proceeded with an acquisition not involving them. And that's really disappointing. And hearing from investors, they're talking about, not having trust in the company.
The deal itself called too big, too expensive, heavily dilutive, and shares have continued to dwindle since. But in late June, the AZEK shareholders, who were allowed to vote, gave the deal the green light, and so the deal was signed and sealed. And the company decided to shift its primary listing to the New York Stock Exchange. A lot of Australian shareholders have since exited the stock.
James Hardie management has made it quite clear that they are now putting more focus with US investors instead of Australian investors and the Australian analysts in that case. So with the acquisition, now the acquisition closed, the result actually showing that AZEK number is a bit weaker as well. Clearly, the company only saw investors only a few weeks ago where with the close of the acquisition, how that variation come into light is now casting a lot of doubt. There's talk of legal case, potential lawsuit that's coming through. We don't know, but there is a lot of discussion on that. Now, even post this sharp share price correction this time around, post this result, management still not giving their time in to see Australian investors that they are making very, very clear they are going to be a very US-focused business.
And to rub salt in the wound, a write-down of AZEK is likely, making the deal look even more overpriced. And of course, given the $4 billion worth of debt on the balance sheet, a dilutive capital raising could be the next step.
So company is now 4 times the debt leverage to earnings. So, usually in this sort of case in Australia, the companies will raise equity. However, I think in the context of US competitors or US companies, the 4 times leverage isn't as high, but I would say there is still a lot of risk because earnings going backwards meaningfully when your leverage is already at the top end of what normally we call it the comfortable level. Should the earning deteriorate any further, equity raising is absolutely on the cards, and that will be very, very dilutive for the company as well, just given where the share price is at this stage.
The company has had a checkered past too. It's facing a class action with investors claiming the company breached its disclosure obligations after cutting its earnings forecast, and this was back in 2022. And of course, who can forget its involvement with asbestos? With asbestos diseases still rising in Australia from products sold by James Hardie installed decades ago. The company already having paid $2.2 billion in compensation to the Asbestos Injuries Funds. Next up for the beleaguered company, the AGM. It will take place in late October and shareholders will come face to face with management.
But I do think it is likely, having spoken to investors, that a second strike could happen. Second strikes are all around remuneration, but often investors that are disappointed will actually vote against the remuneration.
Local investors suggesting to me the board should go in this lesson of what not to do in corporate Australia.
Now, there's something we hear incessantly that makes me scratch my head and just wonder. It's that first home buyers today have got it much, much tougher than people in previous generations. That somehow we owe it to the first home buyers of today to give them more support and to get them into the housing markets. So 5% deposits guaranteed by the government, sure thing. Stamp duty exemptions from the states, no worries at all. But I do vaguely remember buying my own home, the first one. It was bloody tough getting a deposit together. 2 incomes, they were essential to pay off the first stages of a mortgage. So is it that my memory's poor, or is it really tougher today for first home buyers? Angus Moore is a senior economist at REA Group. He's been working on this, and I spoke with him late this week.
Yeah, that's right. And thanks so much for having me, Russ. I think when we think about affordability for first home buyers, it's really important to think about 2 different concepts. So one is what we call affordability, which is essentially, can you service the mortgage on the home that you buy? And this depends on the home price, obviously, but it also crucially depends on interest rates. So that's part one. And then part 2 is the deposit burden. And this really just depends on how expensive is the home that you want to buy relative to your income and your wealth.
So Angus, on that front, that means, is it challenging? Because it seems today that the issue of trying to accumulate the deposit is the big issue for many home buyers.
Yeah, that's right. The big thing that's changed if we look over the last 4 or 5 decades is it is just much harder to save a 20% deposit than it used to be. Home prices have risen much faster than incomes over sort of decades. And what that means is if you're trying to save out of your income, it takes a lot longer. To put some numbers around that, if you were an average income household trying to save a 20% deposit for a median price home across Australia at the moment, it takes about 6 years. That's about twice as long as what it was even in the 1990s and certainly much longer than was true in, say, the 1970s or 1980s. The important caveat here, though, is most first home buyers don't save a 20% deposit. Many buy with smaller deposits than that. In fact, about 3 in 10 buy with a 10% deposit or less. So it's certainly not a necessity to save up all 20% of that deposit.
Okay, so then if we think about in the past, the irony is that interest rates would have been higher in those days than what they were today, which made it easier to accumulate the deposit because people with their savings were able to earn higher rates of interest. So in other words, the low interest rates that have helped people to actually buy more of a mortgage these days and boost home prices also works against them building that deposit.
Yeah, exactly right. And in fact, that's the thing that's changed. If we look over the last 4 or 5 decades, interest rates just are structurally lower today than they used to be and less volatile. We go back to the 1990s, mortgage rates north of 15%. Mortgage affordability and serviceability, so that other part of, when we think about housing affordability, was obviously extraordinarily challenging at that point. It was extremely hard to service a mortgage. Now today, with mortgage rates much lower than that, it's probably nearly as hard to service a mortgage as it was back then, just because home prices are so much higher than they were. Though it's probably not quite as hard. It is still probably the case that 1990 was harder to service the mortgage. But the fact that rates are lower means home prices are higher relative to incomes, and that's a big part of why the deposit burden is so much larger today.
Okay, so let's go back to that era when interest rates got above 15%. They peaked at 17%, as you know. I paid them. But at that point in time, there was also mass unemployment. Unemployment got out above 10%. Unemployment today is just barely above 4%. So the whole issue was that there were a whole bunch of people who got spat out of the mortgage market, the home owning market, because they lost their jobs. And that, I wonder, is really sort of in some ways a protection for home buyers today.
Exactly right. We know that one of the biggest predictors of mortgage default and mortgage arrears is job loss. While obviously the enormous increase in interest rates that we've seen and strain on household budgets that we've seen has been a real challenge for a lot of people, it is possible to juggle that increase in costs. What's not possible to juggle is completely losing your income. And so with unemployment very low at the moment, that risk of job loss is much lower. And so we're seeing that mortgage arrears rates actually remain relatively low at the moment, and certainly compared back to the 1990s when we were facing just a far, far more challenging economic environment than we are today.
But I wonder whether that builds in a danger inside the mortgage market, a complacency, if you like, that people won't lose their jobs, that they may have 2 incomes, whatever might happen. And so that builds also a potential danger into our mortgage market if ever we suddenly get an increase in unemployment because people effectively have maxed out their mortgages. They buy as much as they can, they borrow as much as they can.
Certainly, one of the bigger risks to the mortgage market would be a large, 1990s style recession and a big increase in unemployment. It's certainly something the RBA keeps an eye on. It's obviously an enormous part of their job is making sure those sorts of risks don't materialise and that we keep unemployment low, keep growth happening. The good news is at this stage, we're certainly not seeing that on the horizon. If anything, growth's starting to pick back up. There are some green shoots that after a pretty soft period, we are starting to see some better growth in the economy. And throughout the last 3, 4, 5 years, the unemployment rates remained remarkably low, even despite fairly soft growth.
So do you sense that maybe some first home buyers are choosing markets outside of our major capital cities simply because they cannot afford to buy in those capital cities, which might mean they physically move to be able to afford a home or indeed decide to have an investment property which might be outside of that capital city?
Certainly that's going to be attractive for some buyers given the very strained level of housing affordability. We had a report out this week looking at first home buyers, the PropTrack CommBank First Home Buyer Report, very inventive name there. And what it looks at is where first home buyers are looking and some of the challenges that they're facing. And what we see is the really popular areas for first home buyers are those more affordable parts of our capital cities, or indeed, in some cases outside our capital cities. So, for Sydney, think places like Parramatta or Liverpool are very popular. Melbourne, it's the sort of west and southeast, again, a bit more affordable. So those affordability constraints really are very important for first home buyers and drive a lot of the behaviour that we see.
Okay, so then we've seen with this housing target the government has got to build the 1.2 million homes, the notion of building modular homes, of building more apartments more quickly to try and create more supply. But I just wonder whether the supply is just chasing existing demand, because obviously population is starting to diminish. It's not as high as it was, certainly during the post-COVID years, at least anyway.
Yeah, we have seen a slowdown in population growth over the past sort of 18 months or so, as that snapback that we had post-borders reopening after the pandemic has kind of started to fade and net overseas migrations return to a more normal, more typical balance. What that means for housing is we're not seeing as rapid an increase in demand for housing, but certainly we're also not seeing a rapid increase in the number of homes that we're building at the moment. We had building approvals numbers out just recently, and unfortunately actually came backwards in the month, largely driven by the very volatile higher density approvals. We had seen a big surge in higher density approvals in New South Wales. That looks like it was just a temporary little blip. These are very volatile series, as you can imagine. Big apartment projects come in one month and then don't appear in the next. But even if we look through that, the unfortunate story is we're just not building and approving as many homes as we would need to hit that 1.2 million target over 5 years.
But isn't there irony here that if you build a lot more homes without a lot more population, then you don't want the value of homes to drop if you're an existing home buyer?
It's always the delicate balance with housing affordability. There's obviously a large constituency that wants home prices going up because they already own their own home. I think what I would say to that is just that housing affordability is an issue that affects everyone, even existing homeowners. People look to move, people have kids, grandkids, etc., and you want them to be able to afford a home. And so while we're not expecting that home prices are going to fall even if we built more homes, making them more affordable to more people if we build more would be a good thing for all of us.
I'll tell you what, Angus Moore, always good to have you in the program. Thanks for your insights today.
Pleasure. Thanks so much for having me, Ross.
And that is it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time, and via our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.